Hi, welcome to the video. This video is part 2 for your chapter 2. So in this section, we are going to discuss the concept of goodwill in the partnership. So let's look at the definition first. Occasionally, goodwill will be created when there is a changes in the partnership ownership. Goodwill in partnership can be described as the premium or additional value created by existing partner before the new partner is joining. So this premium or additional value can be described as good reputation, high profit, or well management of business. Goodwill is the difference between the book value of the partnership, we can say net asset or equity, and the fair value of the partnership. So let's use a diagram to explain the concept of goodwill. So imagine today you have a business. This is your business we call ABC. So this business, the net book value, or we call equity, is 100,000. Assuming that today you want to retire and you want to sell the business to others, and in your company is earning good profit, your company is having good reputation, and your company is well managed. So tell me, today if you want to sell your business, so how much you are going to sell? Will you sell at the equity or the net asset value 100,000? I don't think you will sell at 100,000, right? You will definitely sell at a higher amount, for example 150,000. Why you can sell at a higher value? Because your company is earning good profit, is having good reputation, is well managed. Of course, you want to sell slightly higher than the equity of the company. So from this comparison, we know that the equity of the company is 100,000 and you are able to selling 150,000, right? So if you are able to sell at 150,000, this can consider as the fair value of the business. So the difference between 100,000 and 150,000 is 50,000. So this 50,000 is goodwill. Why your business is having a goodwill? Because your company is earning good profit, having good reputation, and well managed, so that the fair value is more than net book value. So we can say that goodwill is the fair value minus equity in the partnership. And for goodwill, this is intangible, non-current asset. What is the meaning of intangible? Intangible means that you cannot touch, you cannot feel it. This is something invisible. So we call this is intangible, non-current asset. Why under non-current? Because your goodwill is unlikely to be finished within a year. It's likely more than a year. So we classify goodwill as intangible, non-current asset. So this is the concept of goodwill. You just need to remember that goodwill is the difference between the fair value to the equity, and the fair value must more than the equity, then you're only having goodwill. If fair value is less than equity, you will not have any goodwill for the company. So let's go to the textbook. Classroom exercise 2.3. Mr. X and Mr. Y are the partners of Brain Enterprise, who sharing the profit or loss at the ratio of 2:1. The following is the abstracted statement of financial position of Brain Enterprise as at 30th June 2017. So from here we know that Mr. X and Mr. Y capital and the current account. And we know that the combination of capital account and current account is equity in your partnership. On 1st July 2017, Mr. Z has joined Bring Enterprise as a new partner. It is agreed that the fair value of Bring Enterprise is 400,000. Z will bring in 50,000 as capital, and the new profit sharing ratio becomes 3:1. Based on the above information, please calculate the goodwill of Bring Enterprise at 1st July 2017. So we are going to do a working to identify what is the goodwill for Bring Enterprise at the date of changes in ownership. So this is classroom exercise 2.4. So first we need to identify the equity of partnership. The equity of partnership, we know that for a partnership, the equity will equals to the capital plus current account. So total equity for X capital is 200,000. So we write 200,000 here. For Y is 100,000. So this is the capital. And for the current account, Mr. X is 60,000 on credit. For Mr. Y is a debit 20,000. And we know that in your current account, if you're having a debit balances, it means that this is a negative amount. So this current account concept I have explained in your chapter 1 video. So take note, when your current account is on credit, this is a positive. If on a debit, this is a negative. So let's get what is the total equity for the company. $200,000 plus 100,000 plus 60,000 minus 20,000. I think some typo here. Let me check again. 200,000 plus 100,000 plus 60,000 minus 20,000. So the total equity of the company is 340,000. So when we get the total equity, we can get the value of goodwill. So goodwill is the fair value minus the equity. Fair value according to the scenario is 400,000 here. So the answer is 60,000 for the goodwill. So this is the computation of goodwill. So the goodwill 60,000. So when you compute the goodwill for the partnership, you have two situations. You have two situations to handle. The first situation is if the goodwill account is created and maintained. Maintain means we keep the goodwill account. If a goodwill account is created, this amount will be credited to the existing partner's capital. amount based on the original profit or loss sharing ratio. So let's handle this situation 1, which is the goodwill account is maintained. Classroom exercise 2.4. Continue from classroom exercise 2.3, assuming that a goodwill account is created from the fair value of partnership. Please prepare the relevant journal entry, goodwill account and partner's current account for Bring Enterprise as at 1st July 2017. So this is an error. This should be 2.3. Sorry for the mistake. And for 2.4, so this is classroom exercise 2.4. So for 2.4, goodwill account is maintained. So first of all, we need to identify how to share the goodwill between the partners. So according to textbook, when you have a goodwill, you need to share with who? Existing partner. Take note, you have to share to existing partner. On what basis? On the original profit and loss sharing basis. So why the goodwill is only for the existing partner? So we come back to this example. We assume that this partnership is from A and B. Mr. C want to buy this business. So tell me, this goodwill belongs to A and B or C? This goodwill belongs to the existing partner. We say the old partner. Why? Because this is the hard work from the old partner to have good profit, good reputation, or well management. These are the hard work from the existing partner. It's not from the new partner. That's why when you allocate the goodwill, goodwill shall only allocate to the existing partner. And how you allocate? Based on the original profit sharing ratio. So let's come to here. So we know that the goodwill of the partnership is 60,000. Who is the existing partner for Bring Enterprise? X and Y. And how they share the profit ratio? 2 to 1. So we have Mr. X and Mr. Y. X get 2 portions, Y get 1 portion. So in total, they have 3 portions. So for X times 2 divided by 3, for Y times 1 divided by 3. So we get 40,000 for X and 20,000 for Y. So this is how we allocate the goodwill. Next, we need to provide the journal entry. So for a better presentation, I will show the journal entry in the whiteboard there. So the first one is when goodwill account is created. So double entry, we debit goodwill account 60,000. We credit to the capital account for X and the capital account for Y, which is 40,000 and 20,000. Take note, when you create the goodwill, you only share the goodwill to the existing partner, or we can say all partner. Next, the next journal entry is capital from Z. So we assume that the amount contributed by Z, which is 50,000, is done by bank transfer. So the double entry is we debit bank account 50,000 and credit to the capital account of Z, which is 50,000 also. So that's all for the journal entry for classroom exercise 2.4. So after that, we have to record the journal entry into ledger. The ledger is provided in your page 31. So for a better presentation, I use the Excel to present. So first of all, let's record the opening balances of your capital. So for the breakdown, Z is 200, 100 for Y, and nothing for Z. This is the opening balances. Where I get this amount? I get this amount from the previous exercise, the capital account breakdown amount for X and Y. So we have to record the first journal entry when goodwill account is created. So we debit goodwill account and credit to capital account. So on the debit side of the goodwill account, we will write capital, and this is for X and Y, 40,000 and 20,000. Debit the goodwill account and credit goes to capital account. So we indicate goodwill, 40 for X, 20 for Y, and nothing for Z. Remember, when we create the goodwill, goodwill only share to existing partner. Next journal entry, we record the capital from Z. So we debit the bank account and we credit to capital account. So this entry is used to record the capital contribution from Z. So since we have finished the journal entry, we can close the account. Goodwill account is asset. For asset, we use balance CD to close the account. And for capital account, we also use balance CD to close it. So we have completed the ledger for classroom exercise 2.4 if the goodwill account is created. Next, let's take a look on the second situation. We have the second situation is goodwill account is being eliminated. It means that no more. If a goodwill account is not carried in the book, it shall be eliminated by debiting the partner's capital account based on the new profit or loss sharing ratio. If your goodwill account is eliminated, you need to debit the capital account based on the new profit or loss sharing ratio. It means that all partners. So let's take a look on Classroom Exercise 2.5. Continue from Classroom Exercise 2.3, assuming that the goodwill account arising from the fair value shall be eliminated. Please prepare the relevant journal entry, goodwill account and partners capital account for Bring Enterprise as at 1st July 2017. So again, I use the whiteboard to present this. So this is Classroom Exercise 2.5. Goodwill is eliminated. Goodwill account is eliminated. So the first journal entry is talking about goodwill account is created. The entry will be the same as exercise 2.4. That's why I don't explain again. The double entry is we debit the goodwill account and credit to the capital of X and the capital of Y based on the original profit and loss sharing ratio. So the second entry is for the goodwill elimination. So for this, we have to eliminate the in the capital account for all the partners. This is why. So how we do the elimination? We use a working over here. Let's go back to textbook. So it says that when you eliminate the goodwill, you need to eliminate to all partners based on the new profit and loss sharing ratio. So the new profit and loss sharing ratio we can get from here, 3, 2, 1 for X, Y, and Z. So for the goodwill elimination, we know we have X, Y, and Z. X can get 3 portions, Y can get 2 portions, and Z can get 1 portion. So in total, 6. So Z should eliminate 3 portions, Y should eliminate 2 portions, and for Z should eliminate 1 portion. Answer: 30,000, 20,000, and 10,000. So this is the amount that we have to eliminate in partners capital account due to goodwill elimination. So let's back to the journal entry. So capital, Z should eliminate 30,000, Y should eliminate 20,000, Z should eliminate 10,000. So total 60,000. And next, the next entry is to record the capital from Z. So the double entry will be the same as Classroom Exercise 2.4. We debit the bank account 50,000 and credit to capital account of Z. So that's all for the double entry. in classroom exercise 2.5. And based on this double entry, we have to prepare the ledger for those entries. So the ledger is provided in your page 32. And I will show my answer in Excel for better presentation. So this one is 2.5 when goodwill is eliminated. So first of all, we record the opening balances. So the first entry is create the goodwill. So the entry will be the same as previous. We create the goodwill, 40,000 for X, 20,000 for Y. And then this entry will credit to the capital account for partner X and partner Y. So you can see that for 2.4 and 2.5, the first entry will be the same. Goodwill is created. Next, we have to record this transaction. Goodwill account is eliminated. So first, we have to debit the capital account. We write goodwill, 30,000 for X, 20,000 for Y, and 10,000 for Z. We debit the capital account and credit goes to goodwill account. So we write capital, X, Y, and Z. So this is the second double entry. We debit the capital account and credit goes to goodwill account. And the last journal entry, we record the capital from Z. So we debit bank account and credit goes to capital account for Z. So that's all for classroom exercise 2.5. And you can see that the goodwill account, the total is 60,000, which is fully eliminated. It means that in your goodwill account, there is no more CD and BD. It means that this amount will not transfer to the statement of financial position of the company. That's why we say goodwill is being eliminated. No carried out, no brought down. And for here, we need to close the capital account as well. So this is 220,000, sorry, 210,000, 100,000, and 90,000. Sorry, 40,000. So we have balanced the capital account, and this will be the new capital amount for each partner. So that's all for classroom exercise 2.5. So if you have any question for this topic or this chapter, you can leave me a message and we will discuss in the live section. Thanks for watching.